Hello and welcome to this edition of the Market Chair. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Erik Clapsaddle, our Senior Fixed Income Portfolio Manager. This is our second of three videos as we start to discuss the 2024 outlook for investors and the markets. Erik, we know that it has been a surprisingly good year for the economy. In fact, we just had the best quarter in about 7 or 8 years. But there continues to be pundits who think we are going to struggle and there's going to be potentially a recession going forward. So can you share some of the drivers that we see for the economy next year?
Sure. So the obvious one, and there are multiple ones, but the obvious one, bigger picture, is going to be the Federal Reserve and how they see inflation and the labor markets playing out. We believe right now they're both heading in the right trajectory. Inflation is subsiding, and the labor markets are starting to cool off a little, going back to more normal levels, though still a very stable, strong labor market right now. But what we think going forward is going to be where the consumer is at. Consumption makes up 2/3 of the U.S. economy. Matter of fact, in the third quarter, consumption increased by 3.6%, and the economy only increased by 5.2%. I shouldn't say only, but that's about 70% of the overall economy came from consumption. You'll see in the chart that personal consumption makes up a large part of overall economic output, illustrated in the light blue line. As the chart shows, the percentage contribution to total GDP over a longer period of time. But we don't really see this changing. We think in the United States and in the Western world that consumption is going to continue to be the primary driver, especially with labor markets continuing to be stable. Wages have risen nicely. Other parts of the economy are going to have to pull back, like federal government, the consumption that the federal government puts out there. And we believe going into the future that this consumer-based economy is going to be the driving force.
So clearly, consumer is important, inflation is important, and that's, to be honest, some of the most important conversations we're having right now on our team. One that we haven't touched on recently, but is truly an important part of the balance sheet of the consumer, is housing. So housing represents about 28% of an individual's net worth. That's a big number.
Yeah.
So how do we think about, or how are we looking at housing in 2024?
Sure. So plain and simple, over the past year, especially, housing market has been resilient on the back of much higher interest rates. Housing prices feeling like they were already at a peak. They continue to be stable. A matter of fact, the S&P CoreLogic Index, which measures housing prices, just reached another all-time high at its last data point. You'll see that in the chart here. This dates back to actually 1987. As it troughed out in 2022, consumers felt more comfortable paying higher prices given the strong labor market backdrop. The outlook for housing, though, is fairly solid despite where rates have moved to. We look at it in the sense that existing home sales are still sitting around their lowest level since 2010, meaning less turnover, less price discovery, adding to price stability with housing. And a lot of individuals are still sitting on legacy low mortgage rates where they're not needing to move and try to increase inventory out there as well, which will add to that sort of shortage of supply, or should I say reduce that supply that's out there right now in the housing market.
Well, Erik, we know housing is important, it's 28%, but I know you're also wanting to talk about interest rates. They're a lot more fun to talk about nowadays than they have been basically for 15 years. So here's your chance. Let's talk about interest rates in 2024.
Sure. Absolutely. So something that we said, and again, I should say this was probably more me, given that I'm a fixed income portfolio manager, is that we thought rates had actually peaked out around mid-2023. Turned out to be a little preemptive on that. For example, the 10-year Treasury just reached 5%, a little over 5% at the end of October. But since then, at the filming of this video, we're down to about 4.25 to 4.3%, and the expectations for rates are to kind of hover around where they're at now going forward, and that's a nice place to be. A nice place to be. Getting 4.25, you add about 1% to that, and bonds look attractive at about 5.25 to 5.5%. But on top of that, what's most attractive about bonds today is the real rate of return you're getting on bonds, which is the yield on bonds minus the effects of inflation. You can see in the chart, the real rate of return is hovering around its highest level since the Great Financial Recession. This real rate of return allows investors to outpace inflation with less volatility than equities. It's important for savers and individual investors. It's important for foundations, endowment, pensions, and other institutional investors. And we expect bonds and the real rate of return on bonds to persist as the Federal Reserve's policies continue to shift to a more normal approach based on historical measurements. Beyond that, the positive about bonds moving to where they've had, it's brought back that traditional portfolio mix of 60% equities, 40% bonds, and it's allowed us to have conversations with clients about even pulling back on equities, taking less risk in their portfolio, adding to bonds, and still getting the same type of return going forward with less volatility forward.
Well, I know our clients have truly appreciated the additional income that they've received in 2023, and that will only continue to go higher in 2024. Erik, as always, we really appreciate your thoughts and comments on the markets. If this is your first time seeing the market share video, we would encourage you to subscribe at firstsource.com. If you like today's video, please share it with your friends, family, and colleagues. And as always, thank you for the opportunity to serve you and your family, and have a great holiday season.